Hi, Brock Vandenberg with TaliMar Financial. I'm getting some calls from investors asking if TaliMar Financial has any exposure to Silicon Valley Bank. The answer is no. We bank with Endeavor Bank right here in San Diego. I've spoken with the bank and they've assured me they're just fine. In fact, they let me know they have over $450 million in deposits, of which $100 million is not invested. They have another $150 million line of credit, which is unused. So I'm very confident in our bank. What happened with Silicon Valley Bank is somewhat of an anomaly. I say anomaly because Silicon Valley Bank catered to startups and venture capital firms. In doing so, they generally held a large amount of cash deposits. They took those cash deposits and purchased mortgage-backed securities, which is very common in the banking industry. Mortgage-backed securities, also known as MBS, are large portfolios of mortgages on residential and commercial real estate. The problem, however, is that these securities generally have a fixed rate and a long maturity duration. And if rates go up, which is what happened over the last 9 months, the value of the asset declines. Imagine, who wants to purchase a mortgage-backed security at 3% when you could purchase a 1-year treasury at 4.9%? The bank is then forced to book a loss, which they technically wouldn't have if they held that security to mortgage, resulting in a need for more deposits to cover those booked losses. However, who wants to deposit their money in a bank that is taking heavy losses? So the opposite happened. People and companies started to withdraw their funds, which quickly made the bank insolvent. The situation hits home for me. As many of you know, I used to actually work for the FDIC. And between 2009 and 2012, it was me and my team that would go into the failing bank on a Friday night and close it. In most cases, we had already identified an acquiring bank and would open the bank the following Monday morning under the new bank with no loss to customer deposits. The biggest difference in this situation is that it wasn't bad loans that brought down the bank. It was quite the opposite. The loans in the mortgage-backed securities were performing well, but rather that the value of the mortgage-backed security dropped because it paid a below-market return. Now, there are some comparisons you can make to investing in trust deeds or a mortgage fund and what happened to that bank. First, we focus on funding short-term bridge loans. These loans are typically 18 months or less. So if rates go up after we fund the loan, we only have to wait 18 months to receive the payoff and redeploy those funds at the new market rate. Second, how assets are booked. Because the securities are considered long-term bonds, the bank is forced to reduce the value of the security, even though if they held the security to maturity, there was a high likelihood that they would be returned their original principal, albeit at a low interest rate. For our fund, on the other hand, because the loans are so short in duration, we generally wouldn't need to account for a loss even if the rate was below market, unless we felt there was a true potential for principal loss. I want to end this video by saying first, I've always been impressed with how the FDIC operated. Even though it's a government institution, the speed and efficiency in which they recognized an issue and took action was extraordinary. If you ever have a chance, Google FDIC in 60 minutes and watch the episode. I think you'll find it interesting. I also want to say that the demand for our capital has never been greater. The failure of Silicon Valley Bank has every bank president telling their staff to increase the amount of liquidity on their balance sheet. That means they'll be funding fewer loans and not extending maturing loans. This will create a huge void for private lenders like us to fill, driving up investor returns even further. In fact, we just completed our preliminary numbers for February, and I think you're going to be impressed. For the last decade, we've had to deal with near 0% interest rates. That has forced investors into buying assets for appreciation versus assets for cash flow. This crushed retirees and investors who were on fixed incomes. The tables have turned completely, and now that investing in fixed income assets, the tables have completely turned now, and those that invest in fixed income assets are in complete control. Martin Zweig coined the phrase, "Don't fight the Fed." Those that are buying assets hoping they will increase in value are fighting the current Fed mandate and will lose that fight. With the Fed raising interest rates, investors can no longer hold onto an asset and expect it to increase in value. Investors seeking assets that offer consistent monthly cash flow will be tomorrow's winners. Cash flow is king, and there is no better place to earn that cash flow than debt secured by real estate. I want to say thank you for taking a moment to listen. And as always, I'm available to answer your questions. And if you like what I said, please give us a like and subscribe to our channel.